Hi, Professor. Before I go into the final case study, I would like to thank you first for a successful semester. You have motivated and always encouraged me to do my best and inspired me to pursue accounting as my major. You are a very great person, and I wish you the best of luck. I hope to see you soon, and happy holidays!
So this is basically the outline of our case study. We are going to talk about the background of the company we have chosen, the purpose of our financial analysis, the decision that we're going to focus on, the analytical techniques that we applied. We're going to talk a little bit about the comparative information and the results and recommendations.
The company that we have chosen for our research analysis is Automatic Data Processing, Inc., who is in the business service industry that provides outsourcing solutions in regards to payroll services, HR management, retirement services, and other employer solutions. ADP was founded in 1949 by Henry Taub and is headquartered in Roseland, New Jersey, with currently 55,000 employees. ADP provides a worldwide outsourcing services together with its subsidiaries to 620,000 customers in 125 countries. There are several accounting policies mentioned in the annual report, but we are going to narrow the policies within the scope of our analysis. One significant accounting policy is the timing of revenue recognition. ADP's revenues are mainly from fees for providing outsourcing service solutions and other client-related funds and fees charged to implement clients on company solutions. Fees associated with services are recognized in the period services are rendered and earned under the service arrangements with clients where service fees are fixed or determinable and collectibility is reasonably assured. However, the fees that are charged to set clients up on the company's platform are deferred until services have begun. Thereafter, fees are amortized to revenue over the longer of the contractual term or the expected client life, including estimated renewal of client contracts. Other significant accounting policies are those that affect assets and liabilities, such as the fair value measurements and depreciation that affects only assets. ADP adopted the U.S. Generally Accepted Accounting Principles that provide for a three-level hierarchy of inputs to valuation techniques used to measure fair value. The company's corporate investment and funds held for clients are based on prices obtained from an independent pricing service that uses various pricing models for each asset class and long-term debt that are consistent with other market observable sources that include benchmark yields and securities, reported trades, broker or dealer quotes, bids, offers, and other market-related data. The company computes earning per share in accordance with Accounting Standards Codification 260. Lastly, ADP transacts business in various foreign countries, so it is exposed to market risk from changes in foreign currency exchange rates that could impact its consolidated results of operations, financial position, or cash flows. ADP's foreign subsidiaries are translated in US dollars in effect for each period, and revenues and expenses are translated at average exchange rates in the periods. Currency transaction gains or losses are included in the results of the operations. The focus of our analysis is to decide on investing in automatic data processing. The application of analytical techniques will concentrate on the profitability of the company. From the results of the financial statement analysis using these techniques, we will provide our findings and recommendations. Why is this relevant? With the applicable analytical tools, you would be able to reasonably expect if ADP will continue in its path to profiting at a gain or loss. So this is crucial for an investor and even creditors to know if the company is able to generate revenues, pay its liabilities, and at the same time pay dividends out to its shareholders.
For ratio analysis, we will be reporting on the profitability ratios that include the return on assets, return on equity, and return on capital, as well as the profit margin on sales, earnings per share, and payout ratio. ADP's return on assets was significantly higher in 2014 and declined in succeeding years. However, the decline in ROA in years after 2014 was contributed by numerous factors. ADP's revenue is generated from its two business segments, employer services and PEO services. The company's ability to increase its revenue is based on new business started during the year, an increase in the number of employees on ADP's client payroll, and the impact of price increases. Although there is an increase in total revenues combined in its two business segments from 2015 and 2016, ADP's combined cost and operating expenses has risen due to an unfavorable foreign currency translation, an increase in its selling expenses so that the company can service its expanding client base, and additional investments needed in product innovation due to the increase in business bookings.
Here is a quick overview at ADP's profit margin on sales, where it shows that in 2015 it had a bigger margin than it is in 2016.
ADP's ROE ratios have increased from 2012 to 2016, which demonstrates that the company is able to generate profits from shareholders' equity. The ADP managed to increase its earnings from 2012 to 2016 that resulted in its return on equity climbing over the years. Generally, it is also a positive sign if the ROE and ROC percentage is higher for a company. The return on capital is a payment received from an investment that is not a taxable event and is not taxed as income. There is an increase in 2016 because the total current liabilities increased, meaning this company incurred more debt. Because long-term debt increased, it resulted in capital increasing in 2015 and a slight decrease in 2016. The payout ratio improved from 2013 to 2016. The average dividend is 2.5%, which increased in the past 5 years and years before then, making the company's income and growth portfolio favorable to many investors.
This graph summarizes ADP's earning per share over the years. It actually fluctuates, but at 2016 it was at its highest at $3.27 earnings per share.
We used 2012 as our base year and compared it to the consecutive years. So from 2012, revenue steadily increased except for 2015. The revenue was negatively impacted by unfavorable foreign currency translation in 2015. ADP has not suffered any drastic decline in net income overall. Therefore, we can reasonably expect that ADP will continue to increase its net income. We use total revenue as the basis for the vertical analysis. It reveals that for the most part, it fluctuates by only 1% in each year. We can also reasonably expect that ADP is consistently profiting every year, however, there is not much change in its business operations.
When we take a look at the vertical analysis of assets, it reveals that current assets are, as opposed to non-current assets in the most recent year, is significantly higher than prior years. This was stated in their annual report that the company mostly invested their client funds in liquid, investment-grade marketable securities, money market security, and other cash equivalents. In addition, it also issued $2 billion in senior notes that have increased its cash assets, which reflect on the trend. And in the next slide, the analysis of the liabilities and shareholders' equity also reveals in the most recent year that long-term debt is higher by 4% from the prior year, which is consistent with my previous statement that ADP had acquired more long-term debt. We have chosen Paychex Inc. for the basis for comparison with ADP, who only does outsourcing solutions for small to medium-sized businesses only in the United States and Germany. One of the differences between the two companies is that Paychex offers a cheaper price for self-service products and services, including Paychex online payroll, internet timesheet, online reports, and general ledger reporting services. In addition, the company offers accounting and finance services, which help approximately 580,000 payroll clients. Paychex is highlighted in color blue and ADP in color pink on the next slide. Let's look briefly at each slide. In comparison to ADP, Paychex's return on assets and return on equity is noticeably higher, which means that Paychex is more efficient in generating earnings from its assets and shareholders' equity and had a higher ratio to profit margins on sales. Although in 2006 ADP had a greater earnings per share than Paychex, ADP's payout ratio was lower than Paychex. For the purpose of the trend analysis on this slide, information was derived from the income statement. More specifically, the revenues from 2012 to 2016 was used to measure the trends between companies who operate in the same industry. You will immediately distinguish that Paychex has generated substantially more revenues than ADP and has also managed to steadily increase from 2012 to 2016. In contrast, ADP was able to increase its revenue from 2012 to 2014, but decrease in 2015 due to the fact that its revenues was affected by foreign currency translations. However, it was able to recover by 2016 when revenues increased by 7% from the prior year. On the vertical analysis of the income statement for 2016, we have used the total revenue as basis for comparison for each company. It reveals that ADP's gross profit is noticeably lower than Paychex by 30%. In addition, the difference in operating income from ADP compared to Paychex is also lower by 20%. Despite the gross profit and operating income being lower by 30% and 20% respectively, DPS's net income, was approximately 13% lower than Paychex. On the vertical analysis of the assets of ADP and Paychex, ADP has more current assets than Paychex. It is also notable that 90% is attributed to current assets in relation to ADP's total assets, which means that ADP's assets has a higher liquidity compared to Paychex, with its current assets at just 76% from its total assets. In regards to vertical analysis of the liabilities and shareholders' equity, ADP's current and long-term liabilities is higher than Paychex. Paychex has not acquired long-term debt and therefore has not accumulated any interest expenses, which is reflected in its income statements over the years. Its business strategy was more focused on aggressively merging and acquiring its small competitors in the same industry to gain more customers. On the other hand, ADP's annual report actually reflects their business strategy and mission on having a strong business model on delivering new solutions to the market, and also stated that the new higher capital structure by the issuance of senior notes was intended to enhance total shareholder returns over the longer term, and not just to temporarily attract investors and shareholders. In comparison to the findings with management's report and our own findings, the results are a decrease in revenue which was impacted by unfavorable foreign currency translations, higher selling expenses, and operating inefficiencies. In addition, changes in laws or regulations may decrease our revenues and earnings and required ADP to change the manner in which they conducted some aspects of their business. In March 18, 2013, the Financial Crimes Enforcement Network announced that there will be no distinction between government currency and digital currencies for the purpose of the money transmission laws. As a payment service, this is important because in 2013 to 2014, we noticed a huge decline in most aspects of our financial statement, which was during the time of this change in the money transmission law. The adoption of this change within our business seemed to have decreased our revenue and adversely impacted interest income from investing client funds before funds are being revoked. Regardless, the financial performance displays a solid revenue growth years after because of the increase in their new business bookings, compliance with new regulations, and this was attained without being affected by the strain on revenues from foreign currency translation and higher selling expenses. Based on the analytical applications that were discussed earlier, ADP has consistently profited each year and has not suffered any operating losses despite its negative impact from foreign currency translations. Both horizontal and vertical percentages reflect a favorable outcome in relation to its net income. However, it needs to find more ways to increase its net income by either renegotiating or increasing its client contracts so that revenues can increase. It is also evident that there was no considerable changes in its business operations, as net income was consistent every year. Due to these findings, ADP needs to re-evaluate its current business operations so that it can identify the inefficiencies in its operations and find more ways in lowering its selling expenses. Particularly, the probably best business strategy for ADP is if it can generate revenue and simultaneously operate more efficiently in relation to increased sales and not increase so much of its operating expenses. This may help improve its profitability ratios. As previously displayed in earlier slides, the analysis and calculated ratios measure the company's performance in a way where investors and shareholders can best understand and depend on to make good investment decisions. One important report is the company's opinion by its independent auditors that states that ADP conforms with accounting principles generally accepted in the United States. This is also crucial because investors can have confidence in ADP's reporting of its financial statements. In conclusion, on an investor's standpoint, paychecks may seem like the best decision to invest your money in due to its higher profitability and payout ratios than ADP, and the fact that a higher payout ratio is usually preferable for investors because a bigger percentage of net income or earnings is being used to pay dividends to its shareholders. This does not always necessarily mean having an advantage. We believe that paycheck is actually at a disadvantage, especially when the U.S. suffers a recession, because of the unavailability of capital to reinvest it back into the company, since a lot of its earnings are going back to the shareholders. On the other hand, ADP focuses on customer service excellence and innovative technology in the global market and not just the U.S. So in our opinion, even though ADP has a lower payout ratio, but with higher earnings per share, ADP's sustainability may be better because it displays a higher capitalization and also reinvests its earning to develop innovative softwares to better their products, focus on long-term client relations, customer service excellence, and then a portion of its earnings are paid back to its shareholders.